A stock market crash story that not many folks know about. During the 1990s, an era of innovation and financial marvels, there was a hidden time bomb known as LTCM. Enter Long-Term Capital Management Group, which actually ended up not being too long-term. It was started by two of the brightest minds, including two Nobel laureates. In its prime, LTCM was the golden child of hedge funds, managing over $125 billion. Its strategy was sophisticated, advanced mathematical models. aka what it specialized in above all else was known as arbitrage trades. It would find weaknesses and opportunities in which that it could profit from small price fluctuations in a variety of different assets. Throughout this arbitrage strategy, LTCM had spread their bets wide and large, thinking that they had every single angle covered. However, they had one massive weakness, the weakness that ultimately ends up plaguing so many day traders who try to be consistently profitable, which was leverage. LTCM had not managed to figure out how to properly leverage themselves. It had not positioned for a global crisis, which came in 1998. In 1998, the Russian government defaulted on its debt, sending a shockwave throughout the entire global economy. Part of this shockwave was taking down many of the arbitrage bets that LTCM had placed out there. One by one, the LTCM trades started to collapse and ultimately fall like a domino that the model simply did not predict. Within months, over 90% of the capital that they managed, $125 billion, had been erased and gone, lost due to the extreme leverage that they had on in all of their trades. A hedge fund that was once considered invincible was now on the brink of extinction. Now, in and of itself, that's not all that big a deal. Day traders blow their accounts all the time. Hedge funds go under all the time. The problem was that LTCM was linked to many giant banks throughout our country. Now, one thing that we know is that if the banks start to fail in our country around the world, we will see the global turnback of those events. Now, the reality is that if LTCM went under, it could drag these major banks under. And by dragging these major banks under, the entire world would be at risk of a global meltdown. Now, understanding the gravity of the situation, who do you think stepped in? Like many times before and many times in the future, the Federal Reserve made a point to step in and prevent this from getting to a point where it would cause a global economic meltdown. Under their guidance, a consortium of banks and financial institutions came together to rescue a crashing LTCM and bring them back to life. Now, the storm had passed, and seemingly this is a story that nobody talks about, and I honestly believe most people out there don't even know about. But the reality was a giant crisis happened to be averted just because the Federal Reserve stepped in to save the day. Now, while this lesson might have passed and we might have had the Federal Reserve save the day, there are three things that you should absolutely take away from this story that you can implement in your trading to be a better day trader in the stock market. Lesson one, LCTM thought that they had a foolproof strategy and plan and thought that they were covered on all bases. But the reality is that no matter how confident you are in a particular trade, a particular setup, a particular chart, a particular strategy, it can always fail. No matter the trade that you enter and how many confluences that you think you have, no matter how many things you think you have working in your favor, the reality is that that trade setup can fail. So overconfidence at any stage that you're at as a trader can be something that kills you. Now, lesson two is that diversification is good. LTCM actually was diversified in their arbitrage trades across a variety of different sectors. However, the problem for them came when they were completely over-leveraged across all of their bets. Now, the way that I like to consider this in trading is, especially in your long-term portfolio, you don't want to be spread too thin without having any cash reserves in case the market were to take a turn. No matter how good your long-term investments look, you always want to keep some cash on hand in case the fact that the market takes a downturn and you need to add or increase your long-term positions in order to make those work. So again, the second biggest takeaway from the crisis that was LTCM is no matter how diversified you are, make sure that you are not over leveraged, as it will be a detriment to your trading account or long-term investment portfolio. And third, our final lesson is that the global system is linked across the board. Now, as a day trader, this doesn't necessarily impact what I do on a day-to-day basis, but what it does signify is that you should be at least aware of certain global events going on that can affect the markets. It does not matter where exactly the event is occurring, it may have an impact on the market, and whether or not you follow that particular news event, you should be paying attention to what is happening on the charts as those events are occurring, starting to draw out scenarios in order to keep yourself safe. Today, thanks to the Federal Reserve, Wall Street stands tall and LTCM is merely a ghost that haunts it in the past. However, as someone who is trying to be an aspiring day trader, I hope that you all take into account the 3 lessons that we can take away as a group from the errors that happened with LTCM. They should serve as a stark reminder in humility, risk, and the unpredictability of the markets overall as a whole. If you found this video helpful, go ahead and comment down below what you would hope to see next or a story that you'd like to hear about in our next video.